Alfonso says, when putting a credit spread, I try to get 1/3 of the width as a credit. So I think you're talking about a 33% return. Actually, I think you're equating, Alfonso, to maybe a 50% return. What is a good rule paying for a debit spread? So I think what Alfonso is asking is that, my apologies, if he's looking at a 1-point spread on, let's say, a bull put credit spread position, so the difference in the strike prices would be 1 point. There we go. Let me just select that. Sorry, Alfonso, bear with me 1 second. There we go. So if I'm selling a 20 strike put on a stock trading, let's say at 23 or so, and I'm selling the 20 and I'm buying the 19 strike, a third, of course, of this difference in strike prices of 1 point would be 33 cents. Now, the way that we calculate the risk versus return on a credit spread is, even though I have a 1-point spread, Alfonso, if I'm collecting 33 cents against the position, the most I can lose is 67 cents on the trade. Which means that in this case, if the stock did fall below 19 in my bull put credit spread, where I'd be obligated potentially to buy shares of stock at 20, but I bought the right to sell them at 19, let's say our stock collapses down to $17 per share, although I'd have to pay the difference of the $1 between the two strike prices to close out the spread in the worst case scenario, I still keep 33 cents. That's deposited directly into my account when entering a bull put credit or a bear call credit. So in this case, the most I could lose is 67 cents. So what I'm seeing here, Alfonso, based on how we show the percent return on power options, you're looking at positions that are almost a 50% return, i.e. looking to make 33 cents on a 1-point spread with a maximum risk of only 67 cents. That's just how we show it in the criteria for the search tool. So if that is the case, 1/3 of the width, 1-point spread, 33 cents. I'm trading a 2-point spread. I'm trying to get 66 cents or so along those lines. A 5-point spread, we'd be looking to make a third of that. So that's going to equate to a percentage return of 50%. So whether you're looking, Alfonso, at a debit spread or at a credit spread, you're going to be looking for returns in the 50% range, which I'm concerned with because I feel that that might only be showing positions that have a 50 or 55% probability above. Please correct me if I'm wrong using the question pod if this is not the type of your positions that you're looking for. But to me, if you're getting your comment of, I want to get a third credit of the width. So to me, that means if I have a 1-point spread, that's a 33-cent net credit, which means the maximum I could lose is only 67 cents because I keep this 33 cents regardless of what happens, even if I have to close out for the maximum loss of 1 point. So that's a 50% return against the true risk of 67 cents. So when looking at bull call debits, Alfonso, looking at bear put debits, I think you're going to be looking for that same return of 50%. Now, let's go ahead and go into bull call debit spreads as a start. Bull call debit spreads, in a sense, is a parity trade to the bull put credit. Instead of selling the put at 20, remember, on our stock trading at 23, and buying the 19 put, we're going to sell the slightly in the money 20 call. Now, Alfonso's not going to be looking at this structure with the return he's looking for. We'll show that in a moment. But I'd be selling the 20 call, which is in the money, but I'm buying the 19 call, which gives me the right to buy shares of stock at 19 to fulfill this obligation of the short call at 20. So even if I get assigned early, my broker should exercise the long to deliver the short. I get $1 back. But in this case, as Alfonso mentioned, I might have paid a debit of 67 cents. So I'm getting a profit of 33 cents off of a net debit of 67, and that is my 50% return. In this situation, an in-the-money bull call debit spread where both calls are below the current stock price, is a parity trade to that out of the money bull put credit spread, assuming we use the same expiration and the same strikes. You'll see almost the same risk and return. But these in the money positions that we're talking about, you're not going to see a 50% return. For what Alfonso is saying, most of the time, if I'm looking for a 50% return on the risk, as we just outlined, I'm going to be looking at an at or slightly out of the money spread, meaning if my stock's trading at 23, this call I'd be selling in the bull call debit might be a 23 or a 24, and I might be buying the 23 or the 22. So I'm straddling the stock price, but that means that I only have maybe a 45, 50, or 55% probability in the next 20 days, 30 days, 7 days, whatever your expiration is, Alfonso, that the stock will be trading above 24. However, as Alfonso mentioned, in this 2-point spread, I might have only paid a debit of 75 or 80 cents, meaning that if the stock is trading above 24, I can effectively buy shares of stock at 22, sell them at 24, I get $2 back. So my initial net debit in this case, this is wrong, but would have been about a 50% return. Your debit would have been closer to $1 only in that case, Alfonso. But with a 33% credit of the width of the strike prices, you're looking at a 50% return as we calculate on power options based on the true risk. The same is true on the debit spread. What am I going to get back versus what I paid? 33% would equate to that 50% return. Again, on a 1-point spread, if my debit, if my debit was only 66 cents, that's the most that I can lose on the position. If the stock fell below both strike prices and both calls expired worthless, I'd lose the whole net debit. But if the stock's trading above, I get the $1 back. That's a 34-cent profit on a 66-cent risk. That's our 50% return. That's how we evaluate it. How would we look for that on power options? We go into bull call debit, of course, and we'd go into search. Now, I'm going to show you the search first, Alfonso, but I'm going to take you to a sample search I think we have for bull call debits and bear put debits that would show the same thing. But let's go ahead and go into our search. And here we see our results that matched our default criteria. And down below, we see initial values, default search to get started. Oh, and there's some positions that are close to what we were just talking about, Alfonso. So if I wanted a third of the net credit, a third of the width of the spread, Alfonso, as a net credit, then the debit is reversed. I'd be saying I want 2/3 debit against the width and the spread. This first one on HPQ almost solves that, doesn't it? Stock's trading at 36.45. Now it's 42 days out. This is looking at a monthly, Alfonso, but we could sell the 19 of July 35 call. Well, we're going to look at midpoint, but the bid is 185, and the 34 strike, 1-point spread, is at 276. The midpoint net debit is 59 cents. So it means I'm paying 59 cents, but if I get $1 back if the stock is remaining above 35 on HPQ, meaning I can buy shares of stock at 34, sell it at 35. You'd probably, I know, Alfonso, sell to close the call and buy to close the other call in that case and get close to the maximum profit if the stock stays above your strike prices you're expecting. Then you'd get $1 back for a cost of 59 cents, and you have a 69.5% return. So when here on Robinhood, with the 18 strike call and the 17 strike call, 1-point spread again, but a debit of 68, meaning that I'd get, it's a little bit above 2/3 in this case. You'd want about 66 cents, but the return here is 48%, almost close to the 50% we mentioned as we show it in the percent return based on the maximum risk. The maximum risk is only 68 cents. That's the most you can lose. The debit you paid, Alfonso. And if it works out as you expect, you get the $1 back. You make a 32-cent profit. Let's take a look at that HP profit and loss chart a little bit more. All right, so what are we doing here in this situation? Well, now again, this is 42 days out. We're going to change the time frame, Alfonso, and we're going to set the criteria maybe if you wanted to go shorter term. It's much harder to find those with a good probability in the shorter term. However, stock's at 36.45. I'm going in the money with the 35 strike. We're $1.45 below, and the midpoint price we're going to get is $1.93. No, $1.9250, but close to it. We're going to target the midpoint. We here at Power Options, when we put our entries into our trading platforms, we always enter in a limit debit or limit credit based on the midpoint prices. Then if we need to make adjustments, if it doesn't get filled, we do so. Never take the natural bid, never take the natural ask, of course, if you can avoid it. The 34 strike at 252, 251.50. There's our net debit cost of 59. And so in this case now, if the stock's trading above 36 at expiration, I'm sorry, my apologies, Alfonso. If we're above 35 at July expiration, well, if we held it through the expiration without closing the position, our broker buys shares of stock at 34. Fulfills our obligation to deliver shares of stock at 35, the sold call strike. We get $1 back. Our debit was 59, so we make $41 against the risk of 59. There's that 69.5% return. Your debit was a little bit lower in this case than the 2/3. You just flip it. I want a 1/3 credit of the width. I'm going to pay a 2/3 debit of the credit, but it's going to equate to that 50% return is what you're looking for the way we show it on Power Options. Now, what is the probability here that the stock's going to stay above 35 in 42 days? Let's go back to our main search screen. And it shows that based on the past trading range of HPQ, we have a 72.2% theoretical probability of the stock remaining above 35 at expiration, 42 days away, where we'd receive that maximum profit. Now, let me take a look here. I'm going to go to the research tool here with the more information button. Alfonso, I want to go into stock research. Just kind of check 827. Okay, so earnings are not a factor. And the fact that next earnings are 827, but it's unconfirmed, means the most recent earnings was 527 about 10 days ago. So they haven't released their next earnings yet, but it shouldn't affect the July position. So based on the past trading range of the stock, volatility of the securities and the options, we're seeing a 72.2% theoretical probability of making a 69.5% return in the next 42 days. Now you want to go shorter term perhaps. Can I go change this and just say, hey, here we are, we're looking for a net debit of this amount or less. We're looking for a minimum 10% return. You know you're looking for a 50% return, 70% probability, avoiding stocks that have an earnings between now and expiration, stocks trading in an uptrend to match our criteria, some basic bid-ask spread and some basic volume and open interest criteria as well, and 3% in the money. I'm going to shorten the time frame, Alfonso. Here's what we're going to do. I'm going to look at all expirations, but I'm going to look at 2 weeks out. That's what I prefer to use for my bull put credit spreads, which are higher probability, looking for more of a 15, 16, 14% return with an 85, 86, 88% theoretical probability, opposed to looking to close to a 50% return in the structure you're talking about with maybe a 70, 65, 60% probability. But let's just look 2 weeks out in time. We're going to go 8 to 15 days out in time. Now let's go 16. I'm sorry, 8 to 16 days out in time. I'm going to bump up our return to 50%. Let's do 45. Okay, so that's on the lower range of what you're looking for. The third net credit against the width, which would equate to a 2/3 net debit. But as we've shown, with the way we calculate the true risk on a credit or debit spread, a vertical spread position versus the maximum profit, you're targeting about a 50% return. Let me go ahead and submit that search. And we've got some results. Here's Chewy. Sorry, I hate these. I hate all the 50-cent strike prices. That's personal opinion. It doesn't have to be yours, but most of these are 50-cent strike differences. Chewy trading at $22.75. Hey, a little bit in the money. the 2050 strike, buying the 20 strike, and we are still avoiding earnings between now and expiration. Net debit of 20 cents on a 50-cent strike difference. So max profit would be 30 cents in that case for 156.4% return with an 87.8% probability. I want to take a look at this a little bit more in depth, Alfonso, because I want to show how you can limit these results. I fear that these bid-ask spreads on Chewy for some reason are way too wide and unlikely to be achieved. In fact, instead of doing it that way, what I want to do, I'm going to change the columns. Rather than go into the research tool and look at all the data that we had as we saw for the earnings date, on the stock research tool, I'm just going to change the columns real quick here. We have the long option ask price. We have the short option bid price. But what I want to add is the short option ask price and the long option bid price. But I want to have them next to those additional columns, Alfonso, those columns we initially saw. So now that I've selected them, I'm going to select change column order. I want the short option ask price next to the short option bid. Oop, one too far. And I want the long option bid price next to the short. I want it first. I want it first. Yeah, I want the long option bid and the short option. Nope, I did that wrong. I'm so sorry, folks. Long option bid before long option ask. That's what I meant. There's where we want to go. So let's submit and save that. Refresh our page here and get our data. There we go. Yeah, a little bit wide here, 237 to 305. 14 days out in time, 21st of June expiration, Alfonso. So our midpoint would be what? It'd be around 270. I don't know if that's realistic. 261 to 320, 60-cent bid-ask spread on a 14-day out option on an in-the-money call. 290 for the midpoint. I think it'd be closer to 310, honestly. Let's restrict some bid-ask spreads here. We've already got a short bid-ask spread of 50%. What does that mean? That means that the bid-ask spread is less than 50% of the bid price. I'm going to drop these down to about 25%. I want them more restricted because as we go deeper in the money, if we go in the money with these debit spreads, you start to see wider bid-ask spreads, more so than the parity trade of the out-of-the-money bull put credit spread, where it might only be 5 or 10 cents for the out-of-the-money bull put. But here we're looking a little bit different. Still fairly wide. I think I want to restrict it to less than 25 cents, and this might hurt the results even more. And instead of doing, no, let's go 30. I want to go 35. My apologies, Alfonso. But instead of going by percentage, I'm going to go by hard number because we're seeing lower strike premiums here. Lower strike securities, my apologies. Yeah. So there's Robinhood again. And it's similar. It's a 50-cent spread difference with a 26-cent net debit, 96% return. Norwegian, 1779, 17 strike, 74% probability. Not bad. 10-cent bid-ask spread. I like it. 20-cent bid-ask spread here on the buy. Yeah, hopefully it works out for us. But a 34-cent net credit on a 50-cent strike difference, Alfonso, 49.3% return, around the wheelhouse of what you're looking for. On holding. This thing is all over the map. It was a couple months ago when it was looking as a married put position, but the bid-ask spreads are not too bad. Why did I restrict the bid-ask spread and cut the results down to 3? Because my fear is with seeing those wider bid-ask spreads on the stocks we were seeing, the $27, $17, $20, $30 stocks of 60 cents, 70 cents or more, I just have a feeling, experience-wise, that you're not going to get filled at the desired midpoint on those frequently. It's going to be less of that. You want to restrict that a little bit more. Now, why am I only seeing 3 results across the universe of options? My stock restrictions are not that terrible. We're just looking for stocks trading above the 50-day moving average. We're looking for stocks trading above $9. We're avoiding earnings between now and expiration. And this is just a straight stock search, so we're avoiding earnings between now and expiration. Wouldn't we think there'd be dozens, hundreds of bull call debit spreads in this time frame, 14 days out in time, that match a good reasonable net debit, 45% return based on how we calculate it, 1/3 debit against a 2/3 debit, my apologies, against the strike difference. Well, there are. The problem is they're not in this range, meaning most of them are not in the money by 3%, and they don't have a probability of 70%. The positions, maybe other stocks you might be looking for, when you're looking for this type of high return on a vertical spread, Alfonso, you're probably more in the range of a 50% probability, and you're probably just slightly in the money or at the money. I'm going to go 0% in the money, just right at the money. Alfonso, let's take a look and see what we've got. All right, now we've opened it, as I mentioned, to 90 results. The ones we were looking at are still in there. I saw Robinhood down here. Here we go. The Robinhood one is still in there. On is still in there as well. But now you've got some AMD, a 167.50 to 165 strike. Bid-ask spread 10 cents on the sell, 10 cents on the buy. Stocks 167.87. These are the ones where you're paying a debit of 135 on a 2-point spread, a 2.5-point spread. Sorry, folks. And you're seeing about 85% return, but look, the probability is only 51%. That's looking at the at or just out of the money bull call debit spread. So I think we saw some good results here with some good probability, Alfonso, where we could increase the probability. I put in 50, but let's bump that up to 60. Still looking for that 50% return, as we explained, with some basic stock criteria in that case. But we're still restricting the bid-ask spread because we want it to be closer to make sure it's more realistic, I should say, Alfonso, that we get the midpoint prices. And this is what I expected to see. With these types of returns around 50 or 60%, more along the lines of a 60, 65, maybe even as high as a 70% probability. Robinhood is extending that, maybe because it has a high implied volatility range. I'm not quite sure. We could do more research on that. But these near term, just at or just slightly in the money bull call debit spreads are the ones you typically see that are offering the 50% return that you're looking for, even 1 week or even 2 weeks out, but the probability is going to be in the 60 to 75% range, not the 75 to 80% range, and not what I prefer to look for in my credit spreads with the 85% range or above, looking only for returns of 14, 15, or 16% with an 85, 86, 87% probability. Okay? But that's what you would look for. If your goal is when you put on a credit spreads, you're looking a third of the credit for the width, that means you're looking for a 50% return. How to use the PowerOptions search to do that? We just illustrated it. I'd like to see restrictions on the bid-ask spread so you don't see something that wastes your time on something you could not get filled on, something with a higher implied volatility, deeper in the money calls that have the wider bid-ask spread, or deeper in the money puts that have that wider bid-ask spread. But the key is, Alfonso, you're going to be looking for a 45% return, but you're going to want to lower your probability at the same time. And we saw 3 positions that looked good. Hey, I might do those as paper trades for our examples. What was it? Let's put it back to where it was. 70% probability, 3% in the money. What could go wrong with a 50% return? Hey, we'll keep track of this. Let's go ahead and do that again. Robinhood, Norwegian, and on holding. So, like I said, these 2 aren't bad. Now that we've restricted the bid-ask spread, we're going to see how these work out. We're going to paper trade these in our webinar account here. See how they perform for us, see how they perform. We'll keep you updated via videos over the week or via, the blog on PowerOptions there on how these 3 meet, and maybe do a comparison versus how that other search that we just sort of created, Alfonso, does that as well.